Before paper money existed, the private bankers who controlled what Americans actually used instead. Think about that sentence for a moment. You probably heard it and imagined a world of barter, commodity currencies, foreign coins floating through colonial ports. But here's what the history textbooks never tell you, and this is the secret I'm going to prove to you by the end of this video. The most powerful private bankers in early America didn't just inherit the chaos of a moneyless economy. They engineered it. They shaped it. And they profited from every gap, every shortage, and every moment of confusion that ordinary Americans experienced when trying to conduct business. This isn't the story you think you're getting. You're not here to learn about tobacco money or wampum or barter networks. Those are the symptoms, not the disease. You're here because you want to understand who actually controlled the flow of value in early America. And that answer sits in the shadows of bank vaults and private correspondence that most people never even knew existed. If you've been following this channel, you already know that American financial institutions weren't built by accident. They were designed. But what you might not know is that the absence of a national currency in early America wasn't a problem that needed solving, it was a gold mine that needed protecting. And the men who understood that dynamic became some of the wealthiest, most influential figures in the young republic. Before we go further, I want to ask you something directly. Have you ever wondered who actually decided what was valuable during these gaps in official currency? Not in the abstract sense, but the specific names and networks. If you have, or if you're at least curious enough to stay and find out, please hit subscribe. And more than that, leave a comment telling me what form of money you think would be most disruptive to the modern economy if it disappeared tomorrow. I read these and I genuinely want to know how you're thinking about this. Wait, this part is important, and I need your full attention for a moment. When most people think about early American banking, they think of one of two things: either complete chaos, or they think of Benjamin Franklin and Alexander Hamilton as these heroic figures who brought order to a disordered system. But the reality is far more calculated than that. The period between 1776 and 1862, when the federal government finally issued the first legal paper currency, wasn't an absence of banking. It was an era of private banking dominance so complete, so absolute, that the men who ran these institutions could literally write the rules of the game as they played it. Here's what gets lost in the standard narrative. The colonists didn't just lack coins. They also lacked institutions with the power to create them or control them. And into that void stepped a very specific group of merchants, lawyers, and men with capital, private bankers who understood something crucial that most Americans were only beginning to grasp. A shortage of currency isn't a natural disaster, it's an opportunity. If you control the circulating medium, you control the economy. If you can make money scarce, you can make yourself indispensable. And if you're the only one who can reliably facilitate large transactions, you become the nervous system of commerce. The first real banking networks in America emerged not from government decree, but from necessity and opportunity. Merchants in colonial New York started lending credit to trusted business partners. Lawyers in Philadelphia began holding deposits for wealthy clients. Merchants in Boston created informal exchanges where they could convert foreign coins, and there were dozens of them circulating, into standardized values they could work with. Each of these developments was practical, even humble in its origins. But cumulatively, they created a system where a handful of well-connected men became the custodians of value itself. And here's where the story becomes genuinely unsettling. These private bankers didn't just manage existing money, they created it. They issued notes, promises to pay in coin, that circulated as freely as currency in their regions. In Boston, if the merchant bank of Thomas and Daniel Boylston said a note was good, it was good. In Philadelphia, the notes issued by the Bank of Pennsylvania carried the full weight of Stephen Girard's reputation behind them. These weren't government institutions. They were private enterprises, run by individual men or family partnerships, answerable to no elected body, audited by no public authority. Between 1776 and 1862, it's estimated that more than 8,000,000 separate banks operated in the United States, many of them chartered by individual states, each one issuing its own notes with its own designs and varying degrees of trustworthiness. Some of these notes held value across state lines. Some of them were worthless outside the immediate region where the bank had reputation. Some of them were outright counterfeited, and the counterfeiting was so sophisticated, so widespread, that Americans in the 1830s and 1840s literally had to carry guidebooks, called banknote reporters, just to know which notes were safe to accept. But here's what makes this system truly remarkable from the perspective of hidden power. The men who ran these private banks didn't need to be in government to control economic policy. They didn't need a seat in Congress to shape the nation's financial future. They simply had to control the supply of circulating medium. And when that medium consisted of 8.000 different currencies issued by 8.000 different institutions, all with different levels of creditworthiness, all potentially subject to counterfeiting, all requiring constant vigilance and knowledge to navigate, well, those men had carved out a position of absolute indispensability. Think about what that actually meant for an ordinary American farmer, or mechanic, or small merchant. If you wanted to buy land, you needed credit. If you needed credit, you had to convince a private banker that you were trustworthy. If you wanted to sell your goods across state lines, you had to navigate a labyrinth of different currencies, counterfeits, and exchange rates. Every single economic transaction that exceeded simple barter required an intermediary, and those intermediaries were the private bankers. They didn't have to mandate themselves into power. The system they inherited, the gaps they inherited, were powerful enough to do that for them. This is where the narrative usually stops. This is where textbooks talk about how messy and chaotic everything was until Alexander Hamilton created the Bank of the United States in 1791, or until the National Currency Act of 1863 finally brought standardization. But that's where we need to pause, because the real story, the story I promised you, is about how these private bankers managed to maintain their power even as the government tried to regulate them, and how they shaped every regulatory attempt to protect their interests rather than challenge them. And we'll get to that in a moment, but first you need to understand something that nobody tells you about Alexander Hamilton. He wasn't fighting against the private banking system. He was reorganizing it. He was formalizing it. He was taking the chaotic, decentralized power of 8.00 banks and consolidating it into a more manageable structure, one that would, paradoxically, give private bankers even more institutional legitimacy and protection than they'd ever had before. The private bankers of early America didn't lose power when the Republic was founded. They transformed it. They professionalized it. They began to work in concert with government instead of against it, negotiating behind closed doors to shape policy in their favor. And the tools they used to do that, the specific mechanisms, the names of the men, the contents of letters that were never meant for public eyes, that's what we're going to uncover in the next section. Because the real control mechanism wasn't money itself. It was the authority to decide what counted as money in the first place. Let me show you exactly how that authority was constructed. Because between 1790 and 1860, something extraordinary happened in America. The country did not have a central bank. No Federal Reserve, no unified monetary system, no official arbiter of what counted as legal tender beyond the Constitution's vague prohibition on states issuing paper currency. What it had instead was a network of private banks, state-chartered banks, unchartered banks, and semi-official banking syndicates that operated with astonishing freedom. And within that chaos, a small group of men figured out how to make themselves indispensable. The Bank of the United States, the first one, was chartered in 1791, and it was supposed to be the solution to the currency problem that had plagued Americans since the Revolution. Alexander Hamilton, then Secretary of the Treasury, designed it. He believed the nation needed a central institution that could stabilize the money supply, hold the government's deposits, and issue its own banknotes that could circulate as currency. It was chartered for 20 years, and it was capitalized at $10 million, an enormous sum for the time. But here's the crucial detail that most histories gloss over. The bank was privately owned. The federal government owned only 1/5 of the shares. The rest were in private hands. Wealthy merchants, investors, and speculators owned the majority. The government put in the capital, but the profits went primarily to private shareholders. The bank's first president was Thomas Willing, a Philadelphia merchant and financier with deep connections to the most powerful families on the eastern seaboard. Willing didn't just run a bank, he ran a shadow financial system. The Bank of the United States issued its own banknotes, which circulated as currency throughout the economy. Those notes carried the weight of federal implicit backing, yet they were issued and controlled by private men pursuing private profit. When the bank loaned money to the government, it charged interest. When it loaned money to merchants, it charged interest. When it speculated on currency fluctuations, it kept the gains. The public assumed the bank was a government institution. It was labeled as such, but it operated as a private entity with public authority. Wait, this part is important. I need you to understand the mathematics of power that were actually at work here. When a private bank issues currency, it doesn't work the way most people imagine. The bank doesn't print money out of thin air, technically. What it does is far more elegant. It creates an asset out of debt. Here's how. A merchant comes to the Bank of the United States and says, I need $1,000 to buy inventory. The bank doesn't hand him $1,000 in coins or government currency. Instead, the bank prints a promissory note, a piece of paper with the bank's seal on it, promising to pay the bearer $1,000 on demand. That note circulates as money. It goes from the merchant to his suppliers, from suppliers to workers, from workers to merchants in other towns. Everyone accepts it because the Bank of the United States is powerful. It's federal sounding, and it's backed by wealthy men with established reputations. The merchant who borrowed that $1,000 now owes the bank $1,000 plus interest. He has to work, sell goods, and generate revenue to pay back more than what he borrowed. Where does the extra money, the interest, come from? It comes from someone else's labor in the broader economy. And the bank, simply by issuing the note, has created money out of nothing, extracted a debt from the merchant, and positioned itself as the gatekeeper of the entire system. This was not hidden, it was legal, it was formalized in the charter, but it was fundamentally different from how the government issued coins. When the government mints a coin, it gains seigniorage, the profit from the difference between the metal's actual value and what the coin is worth in trade. But that's a one-time profit. When a private bank issues currency through lending, it gains seigniorage on every single transaction in the economy. It's not a one-time windfall, it's ongoing, compounding power. And the men who controlled those banks understood this perfectly. Alexander Hamilton knew exactly what he was doing when he chartered the Bank of the United States. He wasn't a fool, he wasn't writing policy by accident. His financial reports to Congress are extraordinarily specific about the mechanics of banking. He understood that by giving a private bank the authority to issue currency, he was concentrating financial power in private hands. But he believed, and this is crucial, he believed this was necessary. He believed that without a powerful moneyed interest at the center of the economy, the government itself would collapse into insolvency. He believed that merchants and bankers needed to have a stake in the government's success, because if the government succeeded, the bankers succeeded. Their interests could be aligned. What Hamilton was really doing was creating a bargain between political power and financial power. The government would grant the bank a charter, status, and implicit backing. In exchange, the bank would provide the government with loans, currency, and financial infrastructure. It wasn't corruption, not exactly. It was a deliberate architectural choice. He was building a system where private bankers became essential to the functioning of the state. Before we continue further, keep this in mind. This wasn't unique to America. European monarchies had been doing this for centuries. They had granted banking charters to powerful families, the Medici in Florence, the Fuggers in Augsburg, the Rothschilds in Frankfurt. The pattern is ancient. A state needs money and credit. A group of wealthy individuals can provide it. In exchange, those individuals gain access to power, prestige, and enormous profit. What was different about America was that the United States had just fought a revolution against monarchy and centralized power. The Constitution explicitly prohibited the federal government from issuing paper currency directly. So the founders created a workaround: delegate the power to issue currency to private banks, charter them at the federal level, and hope that competition and regulation would keep them honest. The problem was that competition didn't emerge, instead consolidation did. Between 1791 and 1811, the Bank of the United States became the dominant financial institution in America. It had branches in major cities: Philadelphia, Boston, New York, Baltimore, Charleston. It held government deposits, it had the implicit backing of federal authority, and because of that backing, its banknotes circulated farther and were trusted more than notes from smaller state-chartered banks. Competitors existed, but they were always fighting an uphill battle. They couldn't match the prestige, the capital, or the perceived safety of the federal bank. When 1811 came around, the Bank of the United States' 20-year charter was set to expire. Congress had to decide whether to renew it. And this is where the real conflict emerged. A coalition of state bankers who had been chafing under federal dominance allied with a group of Republican ideologues who believed that the Bank of the United States was too powerful, too corrupt, and a threat to democratic principles. They had a point. Thomas Willing had used the bank to influence elections. He had extended credit strategically to political allies and denied it to enemies. He had maneuvered to have the bank's branch managers placed in key positions in various state governments. The private bank had become a shadow political power. Congress did not renew the charter. The Bank of the United States was forced to close in 1811, and for a moment it looked like the vision of decentralized banking, power distributed across state banks and local institutions, might actually come to pass. That moment lasted about 6 months. What nobody anticipated was what would happen next: financial chaos on a scale that American businesses had never experienced. Without the Bank of the United States as a central stabilizing force, state banks issued paper money with almost no restraint. Banks that had minimal capital, banks that held no reserves, banks run by men with no scruples whatsoever, all of them were suddenly printing currency. A bank chartered in western Pennsylvania with $100 in actual specie reserves was printing thousands of dollars in banknotes. Those notes circulated until someone tried to redeem them for actual coins. Then the bank would refuse, claim it was insolvent, and collapse, leaving note holders with worthless paper. Counterfeiting exploded. Because the currency system was so fragmented and unregulated, counterfeiters had a field day. They would copy the designs of legitimate banks' notes, print thousands of copies, and circulate them before anyone caught on. A merchant in Boston might accept what he thought was a banknote from a Philadelphia bank, only to discover months later that it was a forgery. There was no central authority to verify authenticity. There was no unified system. There was just chaos. Between 1811 and 1815, the American economy operated under conditions that would make modern financial regulators lose sleep. Businesses didn't know what currency to trust. When a farmer sold his crops for paper money, he had no guarantee that the notes would retain their value by the time he tried to spend them. Some merchants began keeping detailed catalogs of which bank's notes they would accept and at what discount. A note from a well-capitalized Philadelphia bank might be accepted at face value. A note from a suspicious Kentucky bank might be accepted only at 50 cents on the dollar. The cost of conducting business skyrocketed because everyone had to spend time verifying the authenticity and solvency of the currency they received. And the irony, the bitter, perfect irony, is that this chaos actually proved Hamilton's point. The economy needed a strong central authority over money. It needed coordination. It needed a monopoly on currency issuance. By 1815, there was a growing consensus among merchants, manufacturers, and even some Republican politicians that the Bank of the United States needed to be recharged. In 1816, Congress chartered a second Bank of the United States. This one had lessons built in from the first iteration. The charter required that the bank maintain sufficient specie reserves, actual gold and silver, to back a portion of its notes. It required regular inspections and public accounting. It was in theory more regulated, but the fundamental structure was identical. A private institution, majority owned by private shareholders, granted the authority to issue currency and conduct banking operations, with the implicit backing of federal authority. And who became the president of this new bank? William Jones, a merchant and financier from Philadelphia. When Jones died in 1819, he was replaced by Langdon Cheves, another powerful merchant. When Cheves left in 1823, he was replaced by Nicholas Biddle. And this is where the story becomes one of the most consequential power struggles in American history. Nicholas Biddle was not merely a banker. He was, by education and temperament, a titan of intellectual authority. Biddle had studied at the University of Pennsylvania, traveled extensively through Europe, and cultivated relationships with the most influential financial minds of his era. When he took control of the Second Bank of the United States in 1823, he inherited an institution that already wielded extraordinary power. But under his leadership, that power would become something far more deliberate, far more visible, and ultimately, far more contested. Here is what Biddle understood, and what most Americans did not. The Second Bank of the United States was not simply a repository for government funds. It was the nation's monetary authority. It controlled the money supply. It could expand credit or contract it. It could strengthen state banks or crush them by demanding rapid redemption of their notes in hard currency. It could, in effect, make or break regional economies. And Biddle believed, genuinely believed, that this concentration of power was necessary. Without a single, centralized institution managing the nation's money, he argued, the country would slip back into the chaos of the 1810s, when wildcat banks issued currency with reckless abandon, and ordinary citizens had no way to know whether a banknote in their pocket was worth face value or nothing at all. But here is where Biddle's logic collided with American political reality. The power to control the money supply is power over who prospers and who suffers. And in a nation founded on the idea that power should be distributed, not concentrated, the existence of a privately controlled central bank, even one chartered by Congress, became intolerable to a growing coalition of politicians and ordinary citizens. Biddle's greatest weapon was not military, it was economic. Through the Second Bank's network of branches, through its control over credit and its influence over state banks, Biddle could effectively choose which regions of the country would experience economic growth and which would experience contraction. A Pennsylvania merchant could receive favorable credit terms. A Western farmer seeking a loan to expand his holdings might find credit mysteriously unavailable. And because Biddle believed that the Western expansion was destabilizing, that it was driving up land prices and encouraging speculation, he deliberately constrained lending in Western territories. This policy had profound consequences. Western politicians, Western merchants, and Western farmers felt themselves systematically disadvantaged by an institution headquartered in Philadelphia and controlled by Eastern financial elites. And among them, one man would come to embody their rage, Andrew Jackson, who would be elected president in 1828. Jackson was not, it bears emphasizing, a radical. He was a slaveholder. He was a wealthy man. He had fought in wars and held public office. But Jackson understood viscerally that the second bank represented something un-American. Power wielded by unelected men, answerable to shareholders rather than to voters, operating behind the facade of government authority. When Jackson campaigned for re-election in 1832, the recharter of the second bank became the central issue. Here is where we must pause. Before we continue, keep this crucial fact in mind for a moment. The battle over the second bank was not a battle between capitalism and populism. It was a battle between different visions of who should control capitalism. Jackson wanted the central bank destroyed, but he did not want to destroy banking itself. What he wanted was for banking power to be fragmented, distributed among state banks and regional institutions that were more accountable to local communities. Whether that was actually a superior system is a question historians still debate. But the political conviction behind it was unmistakable. In 1832, Congress passed a bill to recharter the second bank. Jackson vetoed it. His veto message is one of the most remarkable political documents in American history, and it deserves to be read in full by anyone serious about understanding American economic power. Jackson wrote, "The Bank of the United States is itself a monopoly established by special act of Congress. Its stockholders have acquired much of their wealth by favors of the government, and it is time they should repay to their country some portion of the favors they have received. It is not our own citizens only who are to receive the bounty of our government. More than a fourth of the stock is held by foreigners. Should the representative of the people permit the alterations made by this act to take effect, he would violate his oath to support the Constitution." What Jackson articulated, however imperfectly, was a genuinely radical idea that the right to control the money supply, to create and destroy credit, to concentrate economic power, was ultimately a right that belonged to the people, not to private shareholders and appointed bankers. Whether Jackson himself believed this consistently is doubtful, but the principle lodged itself into American political consciousness, and it would reverberate for decades. Biddle's response was to dig in. He refused to accept that his bank might be destroyed. Instead, he embarked on what many historians now recognize as a calculated campaign to prove that the second bank was essential to national stability. He deliberately tightened credit, he called in loans, he allowed state banks to fail rather than extending emergency support. He wanted to create a financial panic, a crisis so severe that the public would demand that Jackson reverse his position and restore the bank's charter. It was an extraordinary act of economic sabotage, wielding the tools of finance as a weapon in a political struggle. And in the short term, the economy did enter a period of severe distress. Ordinary Americans suffered. Small businesses failed. Credit dried up for anyone without direct ties to the Eastern financial establishment. But here is what Biddle miscalculated. Jackson did not reverse course. Jackson instead accelerated the process of destroying the bank. He removed the federal government's deposits, hundreds of millions of dollars, from the second bank and distributed them among state banks. This decision, made in 1833, was equivalent to severing the lifeline of the nation's central bank. The second bank would continue to exist, technically, until its charter expired in 1836. But from 1833 onward, it was a dying institution, abandoned by the government that had created it, and opposed by a president who had made its destruction a matter of personal and political principle. Biddle's final years as president of the second bank were spent managing its decline. The institution that had once wielded the power to make or break regional economies was now, essentially, a wounded animal. In 1836, when its federal charter expired, the second bank attempted to obtain a state charter from Pennsylvania. It did, briefly, but it was no longer the same institution. The centralized control over the nation's money supply had been irrevocably fractured, and what rose in its place was something far more chaotic, far less regulated, and ultimately far more dependent on the political will of elected officials rather than on the discretion of appointed bankers. But here is the deepest irony, and the one that connects this entire narrative back to the original problem we began with. The destruction of the second bank did not solve the problem of wildcat banking. It did not create a stable, trustworthy currency. What it created instead was a power vacuum. And into that vacuum rushed hundreds of new state-chartered banks, many of them far less scrupulous, far less regulated, and far more prone to the kind of reckless behavior that had plagued the nation before 1816. The period between 1836 and 1860 became known as the era of free banking, a term that sounds liberating in theory, but which in practice meant a return to the monetary chaos that had plagued the early republic. Banks chartered by state legislatures could issue their own notes, back them with whatever reserve they chose, and essentially operate without meaningful oversight. Some of these banks were honest institutions. Others were pure fraud, shells created for no purpose other than to issue counterfeit currency and vanish before they could be prosecuted. Ordinary Americans caught in this chaos faced a nightmare. How could you tell whether the banknote in your pocket was genuine or worthless? How could you trust any institution? By 1860, Americans had developed an entire parallel economy just to survive the monetary chaos. Newspapers published daily counterfeit detectors, thick pamphlets listing which banks' notes were forged, which were partially backed, which had simply disappeared overnight. A merchant in Philadelphia might reject a note issued by a bank in Ohio, not because the bank was currently fraudulent, but because he had no way to verify its legitimacy without sending someone across state lines. This was the state of American money at the moment the nation was about to tear itself apart. The Civil War changed everything. When the Union needed to finance an unprecedented military conflict, it finally abandoned the fiction that American currency could be built on anything other than centralized federal authority. And this is where the true architects began their work in earnest. The National Banking Acts of 1863 and 1864, passed while the war still raged, created a system that looked on its surface like a compromise. Banks could still be chartered, mostly by states, but they were now required to back their notes with federal government bonds. The currency was no longer pure commodity money, nor was it pure fiat. It was a hybrid, a promise backed by the government's promise, which was backed by the government's ability to tax and to wage war. But here is the quiet revolution that followed. The federal government had finally inserted itself into the heart of American money creation, and once it had done so, it would never retreat. Yet even the national banking system was not the final step. That system still allowed individual banks to issue their own notes, now backed by federal bonds, but still issued locally, still creating regional variation. What came next required a completely different architecture, one that took a national crisis to justify. The Panic of 1907 was the moment that broke the old system. A sudden loss of confidence in New York banks triggered a cascade of withdrawals. People rushed to convert their bank deposits into actual currency, only to discover there wasn't enough actual currency in existence to meet the demand. The entire financial system nearly collapsed in a single week. And in the aftermath of that panic, a new group of architects emerged. Men who had learned the lesson that the Civil War's monetary innovations had begun to teach. They understood that American economic power required not just federal authority, but federal authority with a capital F, a single coordinated institution that could manage the nation's entire money supply. Paul Warburg was a German-born banker who had arrived in America in 1902. He worked for the Kuhn-Loeb Investment Bank, one of the most powerful financial institutions in the country. Warburg had studied the central banking systems of Europe, Germany, England, France, and he understood something that most American bankers and politicians still refused to accept. A modern industrial economy required a central bank. The problem was political. Americans had fought 2 wars against central banking. The first Bank of the United States, chartered in 1791, had been dissolved in 1811. The Second Bank of the United States, chartered in 1816, had been killed by Andrew Jackson's veto in 1832. The public memory of these institutions was deeply negative. They were seen as aristocratic, foreign, corrupt, serving the interests of the wealthy few at the expense of the common people. Warburg and the network of bankers he worked with, men like J.P. Morgan, Benjamin Strong of the Federal Reserve, and Nelson Aldrich, the powerful Republican senator from Rhode Island, understood that they could not simply resurrect the old central bank idea. It would fail immediately, destroyed by public opposition. Instead, they needed to build something that looked decentralized, that appeared to serve the public interest, but that functioned, in reality, as a coordinated system under their control. The Federal Reserve System, created in 1913 through the Federal Reserve Act, was their masterpiece. On paper, it was a decentralized network of 12 regional banks, each with its own board of governors, supposedly serving their local economies. In reality, it was a coordinated cartel of private bankers who now controlled the nation's money supply through a system so sophisticated, so carefully designed, that most Americans never even understood it was happening. This is the secret I promised you at the beginning. The private bankers who shaped American monetary policy did not seize power through revolution or coup. They did not overthrow elected leaders or rewrite the Constitution by force. They did something far more subtle and far more effective. They convinced the government that centralized control of the money supply was necessary for economic stability, and then they positioned themselves to run that system. They did not appear as villains. They appeared as experts, technical specialists who understood finance at a level the average politician could never match. And because they spoke the language of economic stability, the language of crisis prevention, the language of scientific management, they were trusted with power that previous generations had explicitly fought to deny any private banking institution. The beauty of what they constructed was that it had built-in legitimacy. It was not called a central bank, which would have triggered immediate opposition. It was called a Federal Reserve System, a term designed to evoke both federal authority and the reserves held by individual banks. Its governors were appointed by the president and confirmed by Congress, giving it the appearance of democratic accountability. Yet the regional banks themselves were private institutions owned by the commercial banks in their districts, run for the benefit of their member banks. And crucially, and this is the part that separates the subtle architecture from the obvious coup, the system was designed in such a way that ordinary people could go about their lives completely unaware that their financial system was now coordinated and controlled by a network of private bankers working in concert. Consider what had happened by 1920. The United States government had granted a private cartel of bankers the power to determine the nation's money supply, not through dictatorship, but through the logic of expertise, not through coercion, but through the language of economic science, not through visible power, but through invisible architecture. These men did not need to control Congress directly. They did not need to overthrow the president. They simply needed to control the one variable that politicians cared about most: access to credit. When the Federal Reserve tightened the money supply, politicians who had previously opposed its policies would reconsider their position. When it loosened credit, politicians found themselves in a suddenly cooperative mood. The architects of American financial power understood something fundamental about how modern economies actually work. Whoever controls the money supply controls the terms on which everyone else operates. And they had successfully positioned themselves to do exactly that. The profound insight here is this: the most powerful financial revolution in American history was not fought with guns or political upheaval. It was executed through the slow, methodical construction of institutions that appeared democratic, that seemed to serve the public interest, and that were justified by the language of technical expertise and economic necessity. When Americans looked at their money, the new Federal Reserve notes that began circulating in 1915, they saw currency backed by the federal government. What they did not see was the private banking cartel that had helped design the system, that sat on its regional boards, and that would profit from every expansion and contraction of the money supply for the next century. This is how American financial power actually worked. Not through conspiracy, but through architecture. Not through hidden cabals, but through openly chartered institutions whose true function remained hidden in plain sight, embedded in technical language and regulatory complexity that ensured most citizens would never fully understand what was actually happening to their money. The real story of American money is not the story of currency, it is the story of power. The power to decide whose interests get served, whose debts get honored, and whose claims on the future get validated. And by 1920, that power had been successfully consolidated into the hands of men that most Americans had never heard of and would never know by name. If this history changed how you think about American financial power, please subscribe to The Unseen Hand so you never miss another deep dive into the architects who built the institutions that still govern your economic life today. And in the comments below, I'd love to hear, did you know that the Federal Reserve was structured this way? What surprised you most about how American bankers quietly engineered their own power? Leave your thoughts. I read every comment, and your perspective matters. Hit that notification bell so you're alerted the moment a new video drops. Thank you for watching, and I'll see you in the next one.